liabilities, we talked about legacy liabilities over the years. Those remain relatively stable, a little bit higher than they were historically. And with the graph we're going to go through that talks about some of the funding percentages both for the city and in comparison to some of the downriver communities in a minute. Lastly, the city has about $123 million retiree health care liability. That's a pretty good sized number. You did start to fund that liability back in 2018, and so that you continue to pay all the expenses associated with that kind of out of pocket, but there is some funding that's happened now towards that amount, although it's a relatively modest amount. Lastly, in that big set of financial statements that I mentioned, in the very front is a section called Management Discussion and Analysis. That's a really good spot where the city management kind of captures some of the numbers for the years, but some of the story behind the numbers, and there's also some information about kind of forecasting going forward as well. So if you get a chance, if you don't want to look through the full set of financial statements, take a look at that MD&A. I think that's a good spot really to start to get a flavor for how that year looked, and then also the year going forward. So with that, I'm going to pass it over to Bill, and he's going to cover the next set of slides.
Okay, thank you, Doug, and good evening. So as mentioned, my job is I'm going to go through some of the financial highlights of the current year. So what we've tried to do is really take the financial statements, the large 100-plus page document, and break it down into some slides that we think will be useful to go through tonight. So the first slide we're going to look at is a history of general fund revenue. So we have a 4-year trend here, and as we look through the column to the right, 2020 revenues in the general fund were $39.4 million this year, compared to $41.9 million in the prior year. And as we look through the makeup of the various components, you'll notice that really there's two significant categories that decreased in the current year. The first would be charges for services, which is down about $780,000 from last year. And then the other significant decrease was fines and forfeitures, which is down about $1.5 million. The primary reason for those declines is really the impact of the pandemic on the fourth quarter of the city's revenue streams. So as you can imagine, those two are primarily driven by, police officers patrolling, tickets, things like that. And with all of that activity pretty much stopped, that's what led to the decrease in activities there. Beyond that, the remaining categories of revenue remained relatively consistent with prior year. So if we go to the next slide, I want to look quickly at the history of taxable value of the city of Taylor. So we started our graph here in 2010, and if you remember back, it was really 2008, 2009 where we really had the Great Recession, and we saw property values really decline. So the reason we like to go over this graph is it really gives you some perspective on how that recession continues to impact local governments, especially the city of Taylor. So because of the way Proposal A works is the market, or the taxable value cannot exceed the market value. And so when the market values fall, taxable value goes with it. But one of the nuances of Proposal A is it only gets to increase by the lesser of 5% or inflation. So although things have basically recovered and property values for the most part have gotten back to where they were, the city's really not going to see the impact of that on their budget for many, many years to come. So if we compared your 2020 taxable value of $1.3 billion compared to $1.6 billion back in 2010, if you were still at the $1.6 billion, that would be an additional $2 million to the general fund revenue. So we like to show this just because a lot of citizens just assume things are better, you should be back to where you were, but property taxes is going to take probably 10 or 15 years for the city to get back to where you were on existing properties.
10 to 15 from now?
10 to 15 from now, exactly. Because really you're going to go up by, again, 2 to 3% a year. So that significant dive in that 2 or 3 year period is going to take a long time to get back. The next slide, just briefly want to show, how much of the tax bill the city actually gets to keep to fund operations. So obviously the city collects taxes not just for city operations, but also for other governmental entities such as the schools, the county, and other organizations. And so for every dollar collected that people pay on their tax bill, the city actually gets 38.7% of that. So not 100% of the dollars that are paid on a citizen's tax bill go to the city, they go to the other organizations, so we just like to highlight that here on this graph. So as we continue, we'll start to look at the expenditure side of the equation. So again, we have a 4-year graph here of the general fund expenditures of the city, and you can see in the current year, total expenditures were $39.6 million. compared to just over $41 million last year. So that's a decrease of about $1.5 million. And as we look at the components of the various expense categories, really no significant changes in the operations of the city. And the primary reason for the decline, as Doug mentioned earlier, where there were less capital projects in the current year, again, due to the pandemic and some delays in some projects that would have been planned. And if you look in the very bottom category, that other, which is $877,000 this year compared to $1.9 million, that's where those capital expenditures would typically be in there. So that other category is primarily made up of capital expenditures and debt service. So that's where you can see the decline there in those expenditures. So the next graph, we want to take a look at the city's fund balance. So the city ended the year, June 30, 2020, with $12.9 million of fund balance. And we have it listed here by category. And essentially how it goes is the most unrestricted is the bottom line there, the kind of the tan. That's the unassigned fund balance. That's funds that are available to be spent on anything. And then the remaining 5 categories really are funds that have been earmarked for planned future spending. And you can see the largest item included in those various deviations is $1.7 million that has been set aside for the 2021 budget. So essentially when we talk fund balance, and Doug mentioned how much fund balance you should have, typically we refer to the unassigned fund balance because that's really the funds available to spend on future projects and services. If we go to the next slide.
Can I just interrupt real quick?
Sure.
I want people at home to understand that we're talking about the 1920 time frame right here. This is not the current. This is from, we're in the 2021 budget. This is the 1920. I just wanted to, 2020. You know what I'm
Yes, yes. Yeah, this is June 30, 20, yes,
right.
Exactly. So if we look at the next slide, we actually, there's 2 bars. So basically the orange bar there is the total general fund expenditures of the city of Taylor and some comparable communities. And then the green bar really is that unassigned fund balance. And so one of the metrics we often look at is what percentage of your expenditures do you have in your unassigned fund balance? And oftentimes the rule of thumb is you want that to be 15 to 30%. And really that is the working capital available for the city so that you can essentially have cash flows and pay your bills on time. And so as Doug mentioned earlier, so that at the end of the year the city had 22.7% of its expenditures in your unassigned fund balance. And then as you look across, you can see how other communities are doing in that category. I will caution you that it can be difficult to compare communities to each other because you can have different philosophies on how you categorize your fund balance, where you record certain expenses. But I think the bottom line here is the city has done a nice job of maintaining that fund balance and have been able to do that for many years. So I think you're ending the year in sound financial condition, and certainly with the challenges and some of the unknowns as we proceed, it's certainly prudent to continue to monitor that. And the last slide we want to talk about here, I know this can be a little confusing, but this is really the capital investments that the city's made in its infrastructure, equipment, vehicles, and things like that over the last 6 years. So the top line there, that orange line, that is depreciation that the city's recorded. So from an accounting perspective, when you buy a vehicle, for example, you don't expense the whole thing at once. You depreciate it over the life. So if it's a 5-year life, you take 1/5 a year. And oftentimes we'll compare your capital investment compared to that because that just shows are you really replenishing these assets as you use them. And as you can see, certainly over the past 5 years, that capital investment the city's made has been very close to that depreciation line. And actually, if you look at it, the city has invested over $40 million in the last 6 years in the infrastructure of the city. So that's roads, park improvements, building improvements, vehicles, equipment, all those things. So I think this just shows that really you're maintaining your capital assets and continue to invest in the community.